Well, welcome everyone to our annual Meet the Experts. It's so great to see many of you in person, but what's so exciting, it's our first Meet the Experts that's hybrid. We're in a new world now, right, with the pandemic. So now we can all meet the experts not only in person like we used to do annually, but also online. So welcome to everyone who has joined us on WebEx. It's great to see. I'm not seeing the faces, but I'm seeing all the familiar names. So thank you. I find every year this program, even for myself, is very, very informative because as we know, the tax laws keep changing. I think they do that specifically to keep the financial advisors and the attorneys in business. Sorry, because it just gets more confusing every year. But that's what Meet the Experts is here for all of you today, so that we can provide you with relevant information so that you can, plan properly with your portfolio and also with your estate plans. We know with the pandemic, it was a curveball that we did not see coming. And for some, unfortunately, and I hope all of you and your families are staying well, but unfortunately, I did have a friend of mine at the very beginning of the pandemic pass away, and it was sudden. And so I'm sure her family, I don't know what their plans were, estate plans, because it was something like like I'm saying, unexpected. So I think it really is important. We always say you can plan and your plans change, but it's always good to have that plan in place. And that's what Meet the Experts is here for you today. We have Professor Jack Clarke, who's been with me probably for the last 15 of my 17 Meet the Experts as the moderator. He's also my former professor and has probably taught everybody that's online today. Anyone you meet, Jack Clarke probably taught you. Business law at the business school. He received his Bachelor of Science degree from St. John's College of Business Administration in 1955 and his Juris Doctor degree from St. John's School of Law in 1957. And he was admitted to the practice of law in 1958. And he has been in practice, private practice, since that date, continues, specializing in trusts and estates, including extensive experience in estate administration and probate and accounting litigation. And he was also admitted to the practice of law in the state of Florida in 1976. And are you ready for this? He joined the faculty of the Department of Law of St. John's College of Business Administration in 1967. Jack is celebrating, am I correct, 60 years here at St. John's? 62? Sorry, 62 years. A round of applause. And we're so happy and we're so glad he's continuing to teach. He did retire and he came back. He also was the alumni director at one point in his career. But he is part of our gift planning team, and we're really happy to have him. I'm going to have him come up. He's going to introduce Jim McTiernan and Paula and Donna, and they will start the program. I hope you learned something. And please, we want to answer all your questions, so don't be shy. All right? Thank you so much for coming.
Thank you, Susan. It's a lot going on every year. This is a great program. In fact, before the 15 years,
I know.
I did it 15 years before. Things were a lot simpler in those days. And in the past 2 years, of course, everything has gone upside down. We always have changes. It's really good to be back in person. I'm so happy to be back in person in my class as well. I had two classes chock full of anxious young students, so that's great. The last time we did this, we did it completely remotely. And again, a lot has changed since then. And there's a lot of talk about other things that might change or will change. So we've got an excellent panel today. And I'm going to introduce them separately. And we've selected our rotation here to hear from Jim McKinnon first, who's going to talk about wealth management, how you keep your money together and make your money now. And then we'll hear from Paula because the real estate market is crazy again. I've seen it do a lot of things in my 63 years of practice, but it really is crazy at the moment, depending on where you are. And there are so many tax implications and other factors involved. And then we'll finish up with Donna, who is our expert on elder law and trust and estates. And then at the conclusion, we'll take any questions that you might have. You can, those of you who are viewing us online can put your questions in through chat, and they'll come up to me, and we'll sort them out. Those of you in the audience, I don't know if we have anything to.
We have the books,
the
we can
messages
write
on or
down.
questions on. I'll leave that to the technical people as to how that's going to work. So thank you, and let me first introduce, as I said, Jim McKinnon, who is a graduate of College of Business Administration. By the way, just to give you a little history of St. John's, Susan said I graduated from the College of Business Administration. Hate to tell you, it was called the School of Commerce. So I've been through 3 names, 7 presidents, 15 deans, and in fact, before introducing Jim, I said, you realize the room we're in here, the building we're in here, when he was in school, there was the rat skeleton. Get a beer, et cetera, because he was an athlete.
Of course, he didn't partake.
Of course.
So it's always a pleasure to hear from Jim, who really knows his stuff. Very, you have his biography, of course, in your papers, but Jim is a certified public accountant, worked for one of the major accounting firms, and then with Merrill Lynch, and has for a number of years now been with Bank of New York Mellon, where he is in wealth management and really an expert in his field. So without further ado, Jim McKinnon.
Thank you, Jack. And I guess, I kind of prepared more for tax planning, and then you said I'm going to talk about wealth management, but I'm ready to talk about anything. And really, and wealth management and tax planning, they work closely, and integral together. And let's take a look back to March of 2020. As we all were going back, hibernating in our houses and basically starting the process of, what is the future going to be? And at that point, the market had dropped, 35%. People were getting very nervous, and I had many clients that were on the phone saying, please, just sell everything. It's important as you invest your money to look at your asset base of investable assets, the money you're going to invest. And the most important decision is what I call asset allocation. You take a step back and say, what am I comfortable with, and how can I sleep at night and not worry based on how I want my money invested? And there's really 3 types of money. Cash, which again, cash is security, stability. It's not going to generate you in this environment any income, because as you people have seen, when you go to the bank and you look at your statement, you're like, wow, I earned a penny. But then what the bank is stealing from me, So again, cash really is somewhere between, and we talk it in basis points. You can get 1 basis points to maybe 5 basis points, which is absolutely no income at all. Then you have bonds. Bonds right now, we were used to in that category, bonds with CDs. We used to '80s and the '90s, when you go to a bank, you get 5 or 6%. The passbook, age, I'm showing my age, passbook savings, where you would just go to the bank and put your money into a little passbook and all of a sudden you'd see they had to pay you 5.5% of interest. Well, I thought that was a law and it could never get rescinded, but that was gone. And now, in CDs, you might get, 10 basis points, or 0.1%. And bonds, you might get 1%. So for retired people, it's a difficult question on how to allocate your investable asset, because in bonds, you're getting, cash, you're getting nothing, bonds, you're getting about 1%. So you see a lot of people, that move to a little higher risk, which is equities. And equity, as you look at them, most U.S. large cap, good companies, the companies we know, the Procter and Gamble, even the Exxon, even the Microsoft, which is more of a growth company, they're paying dividends of somewhere between 2-3%. Utilities and also what do you call the healthcare companies. So you say to yourself, I'm going to get 3% dividend. Why would I invest in that? Because the bank or the bond, I'm only getting 1%, but there's risk. So again, it's important as you look at your investable assets, how do you want to allocate it? When you're young, I strongly suggest you could be more aggressive because your time frame is much longer. So, that age, starting to work 20 to, 50, that's the time to really, allocate your assets to more growth. That would include equities. It's also the time from a tax standpoint to make sure you contribute, max out on your 401k. This is the time to start to build. That 50, 45 to let's say 65 is the time when you're starting to look to manage it. You say, okay, how many more years do I want to work? So that allocation to the equity should start to drop back from the standpoint of maybe 70, 80, 90%, maybe 50, 60, 70%. And then, when you're ready to retire, I think I was just saying it to Jack, because I have some of my friends are retiring. They said the biggest adjustment to retirement is you're writing out checks, but you have no income coming in. You don't have a paycheck coming in. At that point, you can't be saying, geez, I'm going to make it up by, I'm going to put more money in debt. Again, you lose some of that. Well, some portion, it's going to really hurt because you can't make it up. So, at that point, you're looking at an allocation for somebody, people, it could be to equities, 40, 50, 60%, in that range when you're in retirement. Again, you need growth, but you want to preserve your assets. So, that's kind of just a general question of wealth management. If I have a little more time, again, while we were all hibernating and concerned and watching the market go down, and then amazingly, it came back as quickly as it went down. No one ever expected a rebound in the market, and now we're sitting with the market where it's kind of shaky and there's a lot going on. But while we were kind of home, there was a lot of tax legislation that came in, and I'm just going to highlight a couple points that I think really affect you. Again, as you look at IRAs, there's various types of IRAs, and sometimes people don't really understand the difference. You have your IRA, it's Jim McDean IRA. You have an IRA called a rollover IRA, where I took money out of my 401k and I rolled it over to my IRA. It's still my IRA. You also have a spousal IRA. A spousal IRA would be, if I should pass away, I leave my IRA to my wife. Then there's an IRA that you'll hear, but not most people understand it because it really is different tax implications to it. It's called an inherited IRA. An inherited IRA is if I should pass away and I leave my IRA to my kids. Now, in January of 2020, they issued the Secure Act. That was the first legislation. And in that legislation, the things that affected, us personally and mainly IRAs was that before, when I left my IRA to my kids, they would take it over their life expectancy. So if my children were 40 years old, they would have to take out 1/5. Let's say the life expectancy was 90. They'd have to take 1/5 out every year. 150, 149, 148. Now, what they did, the IRS was like, we're tired of waiting for our tax money from the IRA. It's been deferred long enough. So when you pass away and you leave your IRA to your kids or to someone in the next generation as an inherited IRA, they have to take it over a 10-year period. Now, they don't have to take it in year 1 to 9, but they have to take all the money out in 10 years. That's a big change from the standpoint of the way it was. Now, if you leave it to your spouse, you're married, leave it to your spouse, there's no 10-year period on that. Also, the IRA, you used to not be able to make contributions to an IRA at the age 70 and a half. So if you're still working, like Jack, who's going to work to 110, you still make contributions to his IRA. They stopped at the 70 and a half, but now they start. Excuse me?
Is he really 70?
I don't know. He's lying about it. Make it up. So now you're able to contribute to your IRA. The other thing is that you used to have to take money out of your IRA at 70 and a half. Now it's 72. So again, that's another mechanism. And another thing in the Secure Act was that if you need to take money out for childbirth or adoption, it used to be taxable, but you had to pay a 10% penalty. Now the IRS said that you don't have to pay the 10% penalty up to $5,000. So that was January, and that was the legislation they put through that affected a lot of areas in the IRA. Then in March, I guess they didn't have much to do April 1st because everybody was stuck at home, so they came out with the CARE Act. Okay, we care about you. We feel bad for you. Yes, a lot of people are dying. Yes, you're stuck at home. So we're going to help you out a little. And then one or two things. And the most important thing, which hopefully everybody took advantage of, was that you did not have to take your required minimum distribution in 2020, even if you were older than 70. So that was nice. But now in 2021, they don't care that much about you. They care after the 2020. You have to take your RMD. You don't have to make it up for what you didn't take in 2020, but you do have to take it. And back in 2020, most people didn't know you were able to take $100,000 out of your IRA, and as long as you paid it back in 3 years, it was not taxable. So they allowed you. The other thing to keep in mind when you're doing your tax return, most people are filing, when they file their tax return, they take the standard deduction out. As we all, have experienced, that you can only write off $10,000. It's called SALT. You only can write off $10,000 for your state income taxes, city income taxes, and your real estate taxes. Well, you add those three together, the majority of people, but you can only write off 10. So it's forced a lot of people to elect or kind of have to file standard deduction. But if you file a standard deduction, you still can write off single $300 in charitable contributions for $600 if you file a joint. Okay. Not that it's a lot of money, but you don't want to miss that deduction as part of your standard deduction. And then, in 2020, I don't know if you got it, but, the government was very, very charitable. They were giving, $1,200 to everybody, 24 if you filed a joint return, if your income was less than $150,000. Then later on in the year, they gave you another $600 per person, $1,200. Again, a lot of people did not receive it. A lot of people had to file it on their return. It's been a mess. I know, my dad passed away, and I got a check for $1,200. It was made out to the estate up. So the check was actually made out to a dead person. So again, that's some of the stuff. Quickly, now we have the House Ways and Means Committee in September, and the Biden administration, and we got to start to find ways to raise revenue. So some of the things that are occurring is that the income tax rate, the highest rate is going from 37 to the 39.6. The capital gains rate is going from 20 to 25%. The exemption, which right now the federal exemption is 11.7 million, it's probably going to be dropped down to 5 million, and with inflation, it'll probably be around 6 million. And we should all have this problem. If you have an IRA more than $10 million, you have to take excess out of that. So I mean that's a good problem. But those are some of the general problems. But just keep in mind, with the exemption, the federal exemption, the federal is gonna kind of come down to where the state is, but again, New York State exemptions in that $5.5 million. If your net worth is more than that, you're not taxed on the amount over 5.5 million, you're taxed on the full taxable estate. So I have numerous, and you probably just numerous clients that said they never put their foot in Florida, and all of a sudden buying places in Florida and proceeding on changing their residency because Florida, one doesn't have the state income tax, and Florida doesn't have a state tax. So there's really advantage. Quickly, the last thing I just wanted to say, and I'm probably taking too more time than I should, in making charitable contributions, all my clients, use 2 or 3 variables. One is what we call a qualified charitable donation. If you're going to make a charitable donation and you are in the Army, you have to take your required minimum distribution. It's most tax efficient to make the charitable contribution from your IRA. You get full benefit. Okay, so I can go through, but if you're using a standard deduction and you're making a charity by writing checks, you're not getting any tax benefit. So use your charitable deduction and through your IRA, and all you do is call your financial advisor, Fidelity or E-Trade, and just tell them, and they will issue a check either right to the institution or to give to the institution. Keep in mind, the capital gains rates are going up 20 to 25%. If you have low cost basis stock, and you don't want to pay the gain, and you want to make a donation to a charity like a university here, and yet you don't want to use your cash. Again, if you have low cost basis stock, let's say you have Apple is a big example. I keep transferring Apple stock to different charities. They have a low cost basis. You transfer the Apple stock. Let's say it's worth $10,000 today. You get a $10,000 deduction, but your cost base might be $1,000, so you never pay the capital gain. So again, if you have low cost base stock, and if you're lucky to have the Apple, Amazon, Microsoft type of stocks, it's really a very beneficial way and a good tax strategy too. And the last thing that everybody really has over the years has utilized is what we call donor advised funds. The same thing. Let's go back to the Apple stock. You have a huge gain in it. You want to get a tax deduction because your accountants say, this has been a high income year. You have a high income. But you want to get the tax savings, but you're not really quite ready to make the donation to the charity. You're not sure if this is the right time. You're not sure which one. So what you can do is transfer the Apple stock, get the tax deduction of $10,000 into your donor advised fund, and then that money can sit in your donor advised, and you can make the contributions to the charity in subsequent years. And you don't have to make it as one amount. You can make it, 2,000, to a university like St. John's, 2,000 to your church, 2,000 to whatever. So again, those are some of the benefits. And the last thing, if you do have in your will or in your estate that you want to leave a donation or some kind of legacy to, a charity, the best way is to use your IRA. So, and it's an easy way because you don't have to change your will. So let's say you have an IRA, you call your advisor and you say, I want to give 10% of my IRA to St. John's University, and then so you change it, you sign the form. You don't have to do anything with your will. You don't have to call your attorney. You don't have to pay your attorney to draft a new will, saving money. I'll get out. But all you do is change and again, this is a strong, please take the time to look at your beneficiary designation of your IRA, because generally that could be your largest assets, minus, versus, excluding your home. Make sure you know what it is. And if you want to leave a legacy, or you want to leave some kind of donation to charity, that's where it's the best thing. It can be a dollar amount, it could be a percentage. And then let's say next year you say, I like that university, but I want to keep the 10% to St. John's, but I want to give 10% to my church. All you do is just change the form and sign it, update it with the institution if you don't have it. So a lot of my clients, if they are going to leave money to charity, we do it through the IRA because, again, you can change it by just, I send the form, they change it, sign it, and it's on file. So I hope I didn't miss anything, Jack.
No, I
Okay,
think you did very well.
okay.
Get an A.
And we know who we want to remember with those. One thing, and Donna will, I'm sure, embellish on that, is you can give up to $100,000 from your IRA in a taxable year, which we recommend. Obviously, everybody may not be in a position to give that much money, but that's where to give it. Give it out of the IRA. So that's why I keep working so that I can give it out of my IRA.
If you do that, make sure you tell your accountant, and because when these institutions, including the institute I work with, send a 1099, let's say you gave 10 or 20,000 to the university, they don't document it on there. It says that the whole amount is taxable. So what they do is they check off the box that says amount is not determined. But, an accountant is doing, 20 zillion returns in a short amount of time. They're just picking the number off the 1099-R. So I've had situations where people have filed returns, and I said, wait a second, this doesn't look right. You made it, we gave 15,000 to your university, and we've had to go back to the amendment. So again, you've got to make sure you tell the accountant who does not know.
Yes, excellent point, excellent point. Now, of course, what has really affected us tremendously is the changes that have happened in the real estate market. And our second panelist this morning, Paula Caruso Anaruma, is a graduate of the College of Business Administration in 1983. And I think she's particularly well suited for our panel because started out in commercial real estate and then moved to residential real estate in a prime area where I'm sure she has seen great variations in the prices and of course is always on top of what's going to happen when we have that big capital gain we make the sale. So without further ado.
Thank you, Jack. Thank you. Good morning. I'd like to thank Susan and the Office of Planning for inviting me again to the panel. And just start off with a quick little story, personal story about my son, Joseph, another St. John's alumni, who was living in Long Island City last year. And it was great. It was 7 trains, and he was with his girlfriend, and everything was great. Both of them working in Midtown, Manhattan. He suddenly was not great. By last summer, the city had opened up 3 homeless hotels within a 2-block radius of their apartment. The point where he was afraid to let her walk down the street. She's from Connecticut, Middletown, way up north, and they picked up, went to Fairfield. They chose a place that was halfway between us and bought a house in Fairfield. Paid full price. I set him up with a real estate broker, to represent him as a buyer's agent. Okay. And I said, pay full price, just pay full price. So that was not as crazy as some of the markets that we see here, October of 2020. Since then it's changed. They got married on Zoom in December. And now we have twins, baby girl and boy. So, as you can see, things change. Sounds familiar, right? I wouldn't be surprised if there was a population boom. After everything that's going on with COVID. People more together, living together, seeing more of each other. You get the idea. So people are leaving our inner cities, especially Manhattan, and running to the suburbs and out of state. No surprise there. If we can call this a post-COVID world, still wearing masks, we're still afraid of Delta and various things, getting our boosters. But in the real estate industry, we have seen a shift since this past July. Our big boom was probably March through July. Okay, people went away in August, which is typical for August, but this year I think everybody went on vacation. And when you drove down the street, it was like one of those, during the middle of the day, it was like, one of those things, because people really did want to go away and many of them drove. So that kind of slow quietness has stayed with us for whatever reason. And it's not just in my industry, it's many businesses. I talk to business owners and think we are still a little slow for whatever reason. But we are now starting to see price reductions and longer days on market. And that in my industry, that is the key indicator. How long is a property staying on the market? DOM, days on market. Are we seeing those little red arrows on the MLS going down, down, down? So we're not seeing too many. I really specialize more in Northeast Queens. I do a little of Long Island. I understand that points east going, Garden City especially, booming, way above asking prices, seeing multiple bids, upstate, Westchester, Florida, off the shelf kind of offers. However, Lawrence Yun is the chief economist at the National Association of Realtors, and in June, he quoted, "We may have turned a corner." So when I do speak to sellers who want to put their property on the market, I try to make them understand that you may not be able to get what your neighbor down the street got in March, April, May, June. So things have started to change. And the market is definitely changing. The first indicator that I always notice is in the co-op condo market, where the prices are starting to drop a little more severely than homes. Days on the market has also increased. So I had a co-op that, encouraged the owner in Flushing, great location right off of Northern Boulevard, dropped it $50,000, and we were able to get someone in contract. Same thing with a condo in Woodside. Now we finally got an accepted offer after they dropped price. So these co-ops and condo people, maybe they want to move up to a larger home. So they're looking to buy also. So you see that kind of glut being put onto the co-op condo. So it definitely would impact the seller's bottom line. And the homes market, houses, single-family homes, two-family homes, may eventually follow. However, that really has not happened yet. So we still have extraordinarily low interest rates, low supply, and high demand. That is a seller's market. So that probably will not change anytime soon. So if one of the factors should change, such as an increase in the interest rates, which may happen, if it was enough to impact a buyer's budget, then certainly the market for some sales will change also, and the prices will have to drop. But there are many, many variables that make up a strong, such as demographics and buyers and things like that, which is too detailed to get involved in, but these are the basics. So then you have the investors, because I do have people that come to me as an investor and say, I want to invest. Where would I invest? I want a good deal. I hear that every day. I want a good deal, Paula. So, a good deal was several years ago. I can't remember that. So for the investors who may be looking for a good deal, might even consider the commercial market, which has taken a big hit due to COVID. So the rental market is a little softer, and the retail leasing market is still suffering thanks to online shopping. So you see, many people that had anything that's so those properties free for a lot of money. Now, nobody really wants them because they can't, there's a number of factors that come into play with commercial buildings. And a lot of them are thinking again about this capital gains issue that's coming up. It's looming in the future. That capital gains increase. So that's another problem that's coming up. So when it comes to the multiple bids days, where you've seen 40, 50, 60,000 above asking prices, in Queens, I think it's kind of behind us, but normally the winter is a slow time for us. But as this year has taught us, there's no more normal. So that's the whole point. Whatever things were before, we kind of always had ups and valleys. This has really skewed a lot of, our expectations of the real estate market. Any questions?
Second.
Sure.
Okay. Terrific. And By the way, I'm writing down a number of questions that I have, for both of you. So now we move on. Jim has helped us while we're still working and still thinking about retirement. And Paul has helped us with our real estate investments and selling and buying, et cetera. And now we get to the more somber part because we're calling on Donna and telling them in the twilight of our years or thereafter, how do we plan for our elder years and how do we plan for the hereafter, at least financially? So Donna is a well-known leader in the elder law area in Queens County. She's co-chair of the Elder Law Committee for the Queens County Bar Association, been recognized in the community for her services, graduate of our law school, and was recognized by the law school in 2007 as one of the outstanding younger lawyers who, for her service to that law school. So Donna is very well versed in this area, and it's a pleasure to introduce her.
Well, hello, everyone. Thank you, Jack. Back again. I've been here several times. My voice is a little off. I'm over. My allergies are kicking in. So what I brought to you today, and welcome from everyone at home, is, and maybe we'll be able to get my materials to you at home. So we'll work on that. Okay. So I gave everybody a little folder. All right. So I gave you some sample documents. So you can be any age and need to have documents in place. Okay. So the three major documents for estate planning are going to be your power of attorney, your healthcare proxy, and your will. So you're going to see in the packet, I actually give you healthcare proxies. You can actually fill them out. You can actually sign them in front of witnesses that you're not appointing, and they'll be good to go. All right. The power of attorney law in New York State has just changed. So as of June of 2021, we have a new power of attorney law in New York State. And so I also gave you a sample of what that power of attorney looks like. If you go to any attorney and they're trying to, tell you need a power of attorney, which I highly recommend, especially at a certain age, you should really start thinking about it. Really what a power of attorney is for is in case there's an emergency situation and you can't go to the bank and you can't deal with your financials, then the power of attorney, whoever you appoint, is the person who's going to be assisting you. All right, you should never give a power of attorney to someone if you don't trust them. It has to be someone that you trust. If you have no one to trust, that's a whole nother can of tricks, okay? It's not gonna be, I would not give a power of attorney to anyone if you don't trust them, okay? And that happens sometimes when people don't have family and they don't have friends, and so that's we talk about that, that you should definitely go see an attorney for that. So what you're gonna see, the difference now in the power of attorney is that it now has to be witnessed by two people. So that was not the case in the past. Also, the gifting provisions are right up front. In the last power of attorney, it was a separate document. It was a rider to the main document, and only the rider, which was about gifting, was where you needed to have witnesses. Now, in order to protect people, they've added the witnesses now to the main document. I can see how that can be very helpful because, like I said, it's a powerful document. In the wrong hands, they can do some damage. So you want to make sure that it's done properly. And unfortunately, it's a little confusing, all right? And, I wish that they made it a little simpler so that you could just, download one off the New York State Bar Association website and be able to do it yourself. I don't necessarily recommend that because there's some nuances to it that, your average person is not going to really know or understand. Especially in the gifting provisions, okay? So basically, you're going to see page 3, it talks about gifting. So if you want to allow your agent to make gifts, then you need to initial there in one spot. But then you have to say what kind of gifts you want to let them do in the modification section. So the modification section is usually where I, as the attorney, I'm going to put additional powers. So, I use this power every day. We're always having people execute powers of attorney. I highly recommend it, especially once you hit 70 or you start to get a little older, so that, in case there's an emergency situation, it can be used. My other advice to my clients is don't give it to the person unless, they need to use it, right? They need to know where it is in your house so that they can access it. All right, I'm not giving up my authority. I don't recommend anyone giving up their authority until that emergency happens or there's a situation that arises that makes it like a good idea, okay? Unless you really, it's fun. Sometimes I'll have people that'll come in and they're like, I really trust my children. And, and I'm usually telling them, don't trust them. So like I said, healthcare proxy is all about the health. So, if you cannot make medical decisions for yourself, that's when you want to have a proxy. So there's a couple of different documents. A healthcare proxy is that's New York State's law, and it says my agent knows my wishes regarding life-sustaining treatment. So you need to have a talk with your agent and let them know what your wishes are, okay? So that would be my recommendation on that. And I mean, there's something called the living will, which you'll see, I also gave you these little books that actually explain what life-sustaining treatment is. I've done so many of these, New York State Bar Association, I've done a lot of volunteer work for them, so that's where some of these materials have come from. And you'll see there's a living will in the back. So a living will is basically saying that if I have an incurable disease, or I'm in a coma or something like that, don't resuscitate me, don't. There's a lot of don'ts to that. So if you're a little young, maybe you don't want to sign that, okay? Because, it does kind of tell them, to pull the plug. However, if you don't want to put the burden on someone of making that decision, well, then it's good to have. So some people like it, some people don't, some people do both, it'll go a lot of different ways. And another document that I have in here for you is that, I don't get to talk about fun stuff. Appointment of agent to control disposition of remains. Basically, this is if you pass away, who's in charge of the body. When do we need to really use this is really if you don't have family members that are going to help you, after you pass away. So if it's friends, definitely, because family members have a legal right to, to the body, but your friends really don't. So you would want to make sure that you would have one of these. So again, these you can fill them all out. You can definitely, you can have these and they're ready to go. Just make sure when you do sign them and you fill them out that you use 2 witnesses, okay? And the witnesses cannot be the people that you're naming, all right? So the third document, the will. Okay, so I think Jim already kind of brushed a little bit on the fact that my objective on any given day is to stay out of the courthouse if possible. So if you can do beneficiaries on anything and everything, I would highly recommend that you do so. So then, and again, it's a lot easier to change beneficiary designations on things. So again, I think, going to court is a waste of time and money. So don't tell all my friends, okay? So, so that's just, but sometimes it's a necessary thing. So there's a lot of things that we can do with a will. You can do tax planning with a will. So if you are coming to these limits that, we're talking about as far as, and also, you'll see, I also gave you, and we'll talk about that in a couple minutes, Medicaid rules a little bit of what their limits are on assets and things, and also on taxes, all right? So the tax limits, all right? So for the tax limits, if you're family, let's say you're close to the mark on 5.9 million, or you have 10 million worth of assets. So in the will, you can do something called, and you're married, you can do something called credit shelter trust wills. So what that will says is that the person who, and there's a couple of ways that that can be drafted, but one way would be that you can say that the surviving spouse can disclaim a couple, like some of the assets, so that we can use the tax credit of the first person who passes away. So that's one way that we preserve tax credits and we allow the surviving spouse still maybe to have access to that funds, but they can't control it, okay? But then if we have a couple with 10 million, they have 5 million that goes under the first person and the second 5 million will go under the second person. And now I just cleared 10 million from someone's estate. Of course, I hope everyone here has 10 million, but it's not likely. Most of my clients are not hitting these ranges. There are a few, but so we can do that with a will. If you have a disabled person that you want to leave assets to, we can do that with the will. So you want to make sure that if you have someone disabled, that the money that you leave to them goes into a special trust for them. It's called a supplemental needs trust, special needs trust. And that kind of trust, it will allow them to continue to get their benefits. So it supplements, does not take over their medical benefits and all of their, government benefits. So it's a good thing to do. And then at the end of the day, the money that's in that trust can go wherever you want it to go. So, so it's good if you can still control it. If the disabled person gets money outright from someone, then they have to make their own supplemental needs trust. And that's called a first party supplemental needs trust. And any money left in that trust is going to go to the government for any services provided to that person. So these are some of the things that you can do with the will. You can also do another kind of tax planning, which is called, it's called the Santa Claus. Okay, so the idea of the Santa Claus is that if my estate is going over the tax limits, I want any amount that's going to put me over that limit to go to charity. Because when we make this to charity, it's not taxable, okay? So it'll bring down our estate. So these are some of the things that you can do with the will. And so I think just about the estate taxes a little bit. I mean, right now, the federal government, as you know, they haven't passed anything yet. There's a lot of rumors going on, but Jim is correct. I mean, right now, the rumor is it's going to be probably about equal to what New York State is. New York State is currently $5.93 million, okay? Again, not too many people are hitting these numbers. The thing about New York State, though, is that if we go over, and I think Jim was alluding to this, but I just wanted to clarify it. If we go over the 5.93 limit by only 5%, they will tax your whole estate. And so this is, again, another reason why you want to look at what you have and figure out, again, if you're in these ranges, and I hope some of you are. My other advice to all my clients is spend your money and have fun so that I don't have to try to hide your money later. Or pay taxes, right? We don't want to pay taxes, so that's definitely key. It's so funny, he also mentioned passbook savings account. Let me tell you, my clients come in, they still have passbook savings accounts, okay? It's kind of crazy, but they do. And then the other thing about taxes, capital gains, all right? I think, maybe just to give you a little clarity, capital gains come into play when, so whatever you bought something for, that's your tax basis in that whatever you bought. It could be a house, it could be stock, it could be whatever it is. What you sell it for is where we have capital gains. So if you bought it for $10, it's now worth $100, the capital gains is going to be paid on $90, right? Because it's $10 is what I bought it for, $100 is where it is now. This goes the same thing for houses, okay? So right now, in the proposed legislation through the federal government, they are not, but my understanding is that that is off the table. At first, Biden did have that on the table where that the capital gains, so there's two different ways capital gains to look at it. When you're alive and you sell something, you gotta pay the capital gains. But when you're dead, the capital gains rises, okay? So the person inherits the asset at the date of death value. So that's the capital gains that concerns me and most of my clients, okay, is the capital gains. So basically, if I own stock and I die, they inherit it at date of death value. If I own a house, I bought it for $100,000, it's now worth $1 million, they inherit it at date of death value, okay? And that date of death value is also the number we're looking at when we're looking at the 5.93. So just so that, just to give you a little idea. When capital gains are during your lifetime, just to talk a little bit about houses, what happens with a house is I bought it for $100,000, it's now worth $1 million. If I have a husband and wife, I have a tax exemption. It's $250,000 per person. That's $500,000. So usually, if I'm selling that house, I bought it for $100,000. Now I got another $500,000 on top of that. We have $600,000 now in my tax basis, plus any improvements that I might have made. Let's say I made $100,000, so now I got it up to $700,000. Okay, I sell it for $1 million. I have capital gains of $300,000. Still a lot of money that you're going to have to pay in capital gains, but just to help you to start to understand a little bit, how the capital gains kind of situation works out. As far as charity goes, for 2021, right, what we still have is the CARES Act has been extended for 2021, where it's called the Taxpayer Certainty Disaster Relief Act of 2020. So for charity, right now, if you itemize, and again, you can just confirm that, Jim, you can actually donate up to 100% of your adjusted gross income, but you have to be itemized. Otherwise, the amount that Jim told you about, where you can donate, the 300 as an individual or 600 as a married couple still exists. So again, if you're itemizing, so if you have a lot of income, you might want to think about itemizing and donating to charity to offset the income, right? So that you pay less taxes. So would that be accurate?
It is.
Okay, so just so that, just to give you a couple of things that I think are very important. And the Secure Act, Jim also touched on that. That's a big deal for the IRAs, definitely a big deal, because sometimes they have people that come in, they have quite large IRAs. So, I just want to alert them that, the kids are gonna have to cash those out, so they should think about other things. But for Medicaid purposes, IRAs are protected assets. The only thing that Medicaid can come after is the actual required minimum distributions from those IRAs. So I'm just gonna segue into Medicaid. All right, so I gave you a little cheat sheet. All right, this is the New York State rates on how much money it costs to be in a nursing home for 1 month. So in New York City, they're saying $13,000 a month for 1 month in a nursing home. I'm seeing more, 15,000, it could be more. Long Island is the highest with close to 14,000. Again, I'm seeing higher rates than that where people have to go to the nursing home. So this is what people do. So really, what is elder law planning? Elder law planning is just a step beyond just estate planning, all right? And not all attorneys have the knowledge about the Medicaid. So what happens with the Medicaid was looked at two things. They look at your assets and your income. So the amount of assets that you can have to your name is only $15,900, all right? But if I have a husband and wife, what I'm gonna do is I'm gonna transfer everything except the IRAs to the well spouse, and I'm gonna get the sick spouse the help that they need. The well spouse might have to say, spousal refusal, I'm not paying, but usually I can get them, right now, at least as the laws exist in New York State, that is an allowable thing to do, all right? So when I have two people, I got more options, right? When I only have one person left, that's when the options start to get a little less, okay? So that's why people do Medicaid, estate planning and Medicaid planning, so they can start to protect their assets for their kids and things like that, or whatever other purposes that they have in mind, and tax planning, etc. So when it comes to, so there's a new Medicaid law as well in New York State. So there's been lots of changes that Jack has been telling us about the laws, they're always changing. So in New York State, when it comes to getting home care, you're allowed to keep some of your income, not a lot of it, but a little bit. And then we can, down to the $15,900 plus any IRAs that I have. And if I'm over the limit, which people don't understand, so they're saying that you can have $904 in income. If you're over that limit, usually what we do when we want to keep someone home is we do something, we join a pool trust. So the pool trust gets the excess income, and then we send all the bills to the pool trust and they pay them, okay? So again, this is just some of the techniques that an elder law attorney does in order to get someone qualified so that they can ask for Medicaid. So people think, I'll never get Medicaid, but you can. So what happened though in October 1st of 2020, during the pandemic, Cuomo passed a law that says that if I want to get home care, they are going to now look back on my transfer of assets 2.5 years, 30 months, okay? And this is another reason why people plan, okay? So that means that if I transfer assets now to qualify for Medicaid, then in 30 months, I can now get home care after 30 months passes, okay? When it comes to the nursing home, they take all your income pretty much, and they only let you keep $50. And there's a 5-year look back on the transfer of assets. Okay, so I'm just trying to give you like a general understanding of some of the rules of Medicaid and what the laws do require. When we have what's called the community spouse, like I said, if I have a husband and wife, they say the community spouse, again, I have numbers here on my little list here of how much income they say the community spouse can have and what they like to see the assets look like. Again, sometimes when I see husbands and wives, say if the husband got sick, the wife, sometimes, unfortunately, women got paying a lot less, so maybe her Social Security is only $700 a month. She's allowed to have $32.59, and the husbands might have a lot more. So now she can have his income, so she can get to the $32.59. So that's kind of how Medicaid works. They look at your assets, your income, and, there's planning that you can do. Some of the planning that is done is usually trust. Trust can be done where we do irrevocable trusts, because if you can touch it, which is a revocable trust, there's two different kinds, well, there's a lot of different kinds of trusts, but some of the main ones would be a revocable trust, meaning you control it. And one of the reasons people do revocable trusts is to stay out of court. Or if they don't know where their family is, they came from Europe, they have no clue. These are some of the reasons. They're single, they have no family. An irrevocable trust is a trust where once I put it in, I'm not supposed to take it out. A good attorney is going to usually know how to break their own trust. Okay. However, the idea is you have your kids be the trustees of that trust, so that you still can tell them what to do. And I always usually have provisions in my trust that give you authority to change the beneficiaries or to change trustees in case they're not doing what you want them to do. And there's other things that are done. So, that kind of wraps it up and again, the tax, taxes, the numbers are down here. Right now, it is 11,700,000 for the feds. And that is projected to drop, to New York State level January 1st of 2022. So some people right now who are high net worth people are doing some major planning right now because they're scrambling because they want to try to use, if they have high net worth, some of the tax exemptions that the feds have. But, you have to see, how that works for you. In New York State right now, we do also have, if I make some major gift now, it'll fall back off in 3 years. So I can make gifting now and hit some of these ranges if I wanted to. And in New York State, at least, after 3 years, it falls off the list. The feds keep a list for your lifetime, how much you gave away. New York State keeps a list, but after 3 years, at least under the tax laws as they exist right now, it will fall back off after 3 years. So you have to survive 3 years after you make the gift, if you're in these high ranges. All right, so I think that covers everything I wanted to talk about.
Okay, good. Now, while we're waiting to get some questions, let me make a couple of comments. Donna has given this many times, we've given it together, and you mentioned the Irrevocable Living Trust. And many attorneys, including Donna, would prefer that because people want to avoid probate. And I've always been kind of negative. People who have been in our audience before and heard me say, yeah, it's okay only in situations like she said, all your relatives are in Europe or you have a particular problem. And I was always negative on it for normal families, family with no particular issues. And I still have that feeling. However, I must say that the COVID has thrown everything into a loop. So the probate or administration proceeding is very, very delayed. So while I still think in most simple cases, a will is better, why spend your money up front setting up a revocable trust where you have to transfer everything into the trust? Yes, probably unnecessary and shouldn't be done. But I have to back off a little and say, if you're going to do that, at least have maybe a joint checking account or some ready money for whoever's going to take over your estate because of the tremendous delay. Depending on what county you're in, it can be substantial. Hopefully that will change, but that's the situation at the moment. So, some questions. How do you become an administrator for someone who has passed away with no will? Donnie, you want to do that one?
Usually, the statute and the laws of New York State require you have to actually, there's like certain people who have priority in order to be the ones who file to become the administrator of the estate. So if I'm married, obviously my spouse. If my spouse is already predeceased and I have children, then the children are going to be. If I have no siblings, no spouse, I'm single. Believe it or not, a parent might be, the one who would be the administrator of the estate. Does it happen where we have a cousin or something like that? Yes, because again, we look at the family and we see who has the priority according to the statute. And Jack is totally correct as far as what goes on right now in the courts of New York State. They are very delayed. Right now, if I file in Queens County, they won't even look at my file. They send me an email telling me they won't even look at my file or whatever I filed for at least 8 to 10 weeks. So it's delaying everything. It's caused a lot of problems, I'm sure, in the real estate world as well, because we've had some ourselves. So yeah, and every county is all backed up right now because the court system is a mess.
Yeah. And anyway, how do you avoid capital gains? Wow, that'd be great. But it's a real estate question. You're selling a house. How do you do that? Oh, and then the second question is charitable giving or buy another property. So there's a mixed bag of questions there. So maybe Paul and Donna can collaborate on the answer.
I would say 1031 exchange.
Yep.
So what that is if you have to use a certain vehicle to do it, but you can say anything that's above the limit where there would be capital gains, you can go to buy another property. That's a rental property. You cannot live in that property. There's a couple caveats to it. But that's how people avoid it.
Right, there are rules when it comes to that. And it can be out of state also.
Yes, it can be anywhere in the United States.
It can't be in principle.
It can't be in
It
principle.
has to be business property.
Yeah.
And interestingly, that's why I was particularly interested in Donna's remarks about we don't know where the tax laws are going. But one of the ones that would concern me is if we did away with the stepped up value at the date of death. This could be tremendous because it could really hurt what you leave behind. To give you a far out example, I mentioned to Paul earlier today, the first real estate transaction that I handled in 1958 was for $14,000. Can you imagine if somebody died now and left that, the capital gain on that? It's in an area in Brooklyn that probably at least $1 million. Wow, what a difference that makes with the capital gain being at the stepped up value. Makes a major difference. So I hope we're right that it's off the table. But we don't know. And we don't even know really whether it's going to go down to the 6 million because the current federal law is set to expire in the sunset in 2025. But the legislation that they're talking about at the moment is to do it immediately. That has to pass.
If you want to piggyback on the capital gains, you can also, after you've hit your deduction, you can deduct any money you spent on appreciating the property, like did you put a new kitchen in, did you put a new roof, any type of improvement. So if you spent $100,000 in improvements over the time you had that house, now you deduct that off the gain, so you have tax less.
Yeah. That,
Okay. If I pay off my niece's student loans by direct payment to the lenders, would she have to pay taxes on that amount? What a general.
No, you would not have to pay tax. You just want to make sure if you're paying the student loan, it's considered a gift, and you can make an annual gift of up to $15,000 a year. File a gift.
Right. But that gift, if it's for education in that way, would not be considered, would not go over the annual exclusion. Is that correct?
Well, I know if the gift is paid for schooling, education, you have to pay for medical, you have to pay directly to the doctor. For not to be fall under $50,000 annual gift, you have to pay the educational institution. Again, depending on where that loan is, if that's a private loan, I don't know if that would fall under
I might add something that comes up all the time with the question of the gift, the annual exclusion of $15,000. That's to as many people as you want. So you can give 100 $15,000 gifts and not have to file a gift tax return. They're all excluded. However, even if you, for the most people, for the having to file a gift tax return because you gave more than 15,000 to somebody, it's not a big deal because you get a lifetime exclusion currently of the 11.7 million. So unless you're in a very big category and giving an awful lot away, that filing of the gift tax return is kind of an exercise that there's no tax because you're going to take your credit. So a lot of people are, I can only give away 15,000 or, no, you can give a lot more away depending on your overall status, your overall wealth, et cetera.
How did the online participants comment?
Advantage of a irrevocable trust versus a will. Is there an advantage to have a trust versus a will? Well, that's it's in lawyers like Donna and
Honestly,
myself.
I agree with Jack.
Talking about
I only recommend them in certain situations.
Yeah.
I really don't recommend them in all situations. So I agree with Jack on that. It's usually, that's not necessarily the best
Yeah.
plan. The one thing it does, it keeps you out of the courthouse.
Well, I tell you, I have a situation right now. I just got a call the other day. Well, I'll tell you two situations. And this is typical of what people do. The call I got the other day was that they thought this person had a will and they can't find it. And I said, well, I can't imagine they didn't do anything because she made funeral arrangements, which, by the way, you can make for Medicaid purposes directly. Went to that trouble and didn't have a will. That was unusual. So they found a card for a law firm, and I said, oh, that law firm, they're big on trust. They must have done something. And the call was made, and they said, no, we have no will. We have a profile here for that person. That means, I think, that she went in to see them and heard the court and decided to do nothing, and now have no will. No big problem, except all of her heirs at law are non-resident aliens. In other words, they live, in this case, in England and Ireland. Not an impossible situation, we can handle that, but that would have been a good case for a living trust. Even I would recommend that.
Just when I wouldn't close the home, I got like 50 cousins in England and Ireland. And my first cousin passed away and he didn't do his stuff. He didn't do anything. And then in County Leash, they had this sugar beet farm and a little dairy farm, not worth a whole lot. But my poor second cousin is running all over Ireland with attorneys to set up, going through probate now, what they call probate, because it's like 50 people that can get their hands on this. He's going to spend more on legal fees than what those stupid little farms are worth.
Yeah, it's quite possible. The other quick story, a gentleman came in with his cousin. The cousin was a client, and I had done some business for the family, straightening out some property. And they said, I went in to talk to somebody about a will. I'm a single guy, and they wanted to give me a living trust because I don't know about the family, on the paternal side, et cetera. And he said, but they wanted $8,000 to draw the trust and so on. I said, well, you better get something. You should at least have a will, because even if you have a will, so it leaves some trouble for those who succeed you, but that's okay. They can afford to do it. It's a little extra work. He didn't need that. He dies and the cousin comes in and said, okay, our 7 first cousins inherit everything, right? I said, no, wait a second. How about the other side of the family? And, well, there is nobody, or we don't, there's always somebody. And there were 5, and we ended up splitting 50-50, over $1 million. It's, a simple will would have solved that problem, and he would have left it to whomever he wanted. And, so this is quite common. We put these things off, you don't want to think about it. And in some groups, there's the feeling, if I make a will, that means, so.
Hi, this
That's not
is
the
Damon
case.
Urso.
I guess I have all the questions.
This is Damon Urso.
The other one?
Just piggyback off a comment for Donna. By not setting up that POA, and you're diagnosed with dementia before setting up the power of attorney, they could then assign you to a guardianship, which is very expensive. It could take a year to set up. For Paula, I just read a thing in the Washington Post yesterday that FEMA estimates that flood insurance is going to increase like 18% a year for the next 20 years. So for people who are now buying properties in waterfront areas, that's a wake-up call. And then I have a question for Jim. Is a discussion about this Biden doing away with the backdoor of Roth, where someone with a 401k can put after-tax money into a 401k or an IRA and then do the Roth conversion without paying the taxes. And he's looking at doing away with that. I was wondering if there's any scuttlebutt on updates on that, or?
We discussed a lot with Roth conversion. Basically, we would be taking an IRA and converting it to Roth. Generally, people younger than, I would say, 60, would be general, because what happens is, let's say your IRA is worth $1 million. Both sounds good, because after you get to Roth, that $1 million can grow to $5 million and you never pay income tax. But you gotta have to pay the 300-something thousand on the conversion. But when you write that check, when people, they're like, this sounds great, it's like, okay, then you're gonna probably have to figure out, you write a check, and it has to come from assets outside your Roth, because you wanna convert the whole Roth. So most people are kind of a little more apprehensive about moving forward. But if you're young enough and again, and you have the capability, someone would say they're 40, has a large IRA, even if, let's say it's $500,000, they take $150,000, and in their 40s, and they take that money, and that $500,000, they live through their 80s and 90s. You don't have to take distributions, that $500,000 now is $5 million. The government gets no income tax. It's included for the state tax.
This is my question. What Biden wanted to do away with was the ability for you to put your after-tax money into
Roth, yeah.
into an IRA.
IRA, yeah.
Okay, and then they take it out, so they're talking about.
Yeah, there's no, you get it. So you do it on a deductible IRA, and they're trying to, stop that, because people putting money in IRA without deducting.
So, thank you very much. I think we've done our job, and I'll return the podium to Susan.
Thank you, everyone. I hope this was very informative. I hope you learned. I hope we encouraged you to go
How
see
can the
an
participants
advisor
have
to
comments?
put together your plan, your estate plan, your financial plan. Just one other thought. I know we were talking about charitable planning. I'm director of the McAllen Society, which is the St. John's Legacy Society. Wonderful, wonderful group of people who are leaving St. John's in their estate plans. It's all about community. It's a commitment, but also we do these social events, cultural. So it's really great if you want to be a part of a group, if you're retired, you're looking to do something. It's really a great way to get back and reconnect it to St. John's. Standing right alongside me is, well, he's in many societies, the founders,
I
the
think the online
but also
participants,
a McAllen Society member, so
comments.
on the spot. Is there anything you'd like to share with the group very briefly of your experience or why you joined the McAllen Society?
Okay. All right. I did it so Susan would have good customer. because people should, I think, pay back. You know, my experience, way back in 1952, I started at St. John's in the then School of Commerce down in Brooklyn. And I was not a great student, but I had no money. My father had died early, when I was 9, you know. And I was encouraged to think about college all of a sudden. So I did. One day I woke up, you know, at the you finally wake up. And I went to the library and looked at all the books and all the catalogs of the various colleges. And they all had scholarship, competitive scholarship. The top students or take an exam or whatever. St. John's was the only school that I found that had a provision saying we render financial assistance to those in need. I wrote a letter to St. John's, and I still have this letter. I should have wrote it. Telling me you've been accepted and your tuition will be $100 a year, subject to, and those things probably $700. $100 a year, I can handle that. And I had that right through. So I think I owe them something. And over the years, I've given, I have several scholarships and other things going on, but don't I owe it? And I think this is the way to give it. Give some of it, well, fortunately, I'm still working, so, you know, can do it currently. But all of us are going to leave something. Why not leave something to pay back? And that's my feeling. I've encouraged people for years. So I don't know if that's a.
How do the online participants share their comments?
Donor to the university, not
How do
only
the online
in sharing
participants share
his,
comments?
his success, but also volunteering and his time. And like I said, he's on our faculty at the Peter G. Tobin School of Business. So thanks, Jack. I guess I hope we answered all your questions, but if we didn't, please send us an email. There'll be a follow-up. We can share some of the documentation that Donna has given to anyone that was here in person. So everyone, please stay healthy, safe, and please stay connected to St. John's. And thank you so much again. Have a great day.
Very good. Well, thank you.
Good.